I'm gonna cut all of this shit out. Okay, so here we go. Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the feedback from the 11ish collective. A lot of you are beginning investors and you are looking for more fundamental questions that you are interested in answering. So I have one of my close friends on this call because he is looking into getting into investing and he has some very interesting questions that I thought I would answer through this format. With that being said, I have Ahmed with me. How's it going, Ahmed?
Hey, Steve. Doing pretty good. How about yourself?
Excellent, excellent. So without further ado, let's get started. Throw me your first question. What do you got?
I guess a little bit of context on my end. So, I'm aware of what the stock market is. I know what a share is. Like, I have some vague idea of like how it all plays together and like how companies IPO and so on. And I've played around with Robinhood a little bit, and here and there I've like bought random shares. But I've never really invested enough to actually make it any form of lucrative thing. It's always just kind of been, make or lose a few $100 here or there just while I'm playing with it.
Yeah.
But one of the things that I would really love to learn or really get to know more about is how do I take this to the next level? How do I actually begin to use the stock market as a way for me to earn an additional income and start having, if you want to say, what a lot of folks are calling that side hustle. And I think one of the first things that I think hits a lot of beginners, especially myself, is kind of that fear and trying to understand like what is the right mindset that I should be going into this. It's at times it's really easy to look at numbers and think, oh crap, like that's a very large amount of money. Like, do I really want to invest, or do I really want to buy a share for $200-300? And maybe that's not the right thing, but hopefully that's what I'm looking to learn about here today.
Yeah. Those are really legitimate fears and concerns that we are all very, very much aware of, right? No matter which scale you play at, we always think about those things that you just mentioned. And in terms of the mindset, let me just get a little bit of background. In terms of like, the stocks that you played with, what was percentage-wise? What was your rate of return on average?
Actually, as odd as this sounds, I think my largest, I can pull it around in the meantime, but I think my largest rate of return was off of Square stock. That I bought in like 2016 just for fun. And It was like $8 a share at the time. Yeah. And I thought, oh cool, $8 a share. I like the POS. It looks cool to me. I'll just buy like $50 worth. Yeah. And I think now it's what is it, $200 a share or something. So I mean that's been the most decent thing, but it's just been out of sheer luck, and that's mainly what I'm talking about. Where, I bought that just based off of the fact that I liked the way their points of sale looked. It wasn't so much that I had any type of education or any logic to why I did it. There's no concrete proof as to why I should do that.
That's fair. And my other question to you before I answer is, what made you decide to hold it for so long?
Just laziness, honestly. Laziness and fear, I would say. Laziness out of not wanting to actually go in and deal with it, and then also just fear of the unknown around what happens if I sell this? How do I do this on my taxes? And being that it was such a small amount of money, I figured I just don't want to deal with it, so I'll just leave it there, and maybe one day it'll be worth something.
Ultimately, the way I tell people to look at investments in general is kind of like how I expect them to look at businesses. And what I mean by that is you always want to start small, build a proof of concept. If it works, then you scale up. It sounds like you're pretty close to inadvertently building a working proof of concept, being that the investments you mentioned paid out percentage-wise. It didn't do very bad at all. You have a tendency of holding for a long time, even though it's not for the right reasons. But I mean, like the strategy is rational. So ultimately, you have inadvertently bumped into the right approach. Now, in terms of the mentality, there's always a time to make money. So you should never feel like you shouldn't have this mentality that like it's hot right now, so I need to get into the stock market right now. Right? It's more about whether I see something that other people don't, whether there's a market gap that other people don't realize. Because if there isn't, for example, if everyone thinks Tesla is hot, everyone is paying for it, which they are, then it's a lot harder for you to make money on Tesla because that value is already built into the stock. Whereas if you find something that you're familiar with, like kind of like exactly your example, Square, there's a time back in the day when people thought that was a stupid concept. Like most people were not on board to that concept, even though they were making a shit ton of money, right? If you realize the value out of that technology or the business, and the stock isn't overvalued because most people aren't appreciating it, right? Then you should invest in that stock. And as you pointed out, I mean, you're holding on because you got lazy, as you say, which I frankly doubt. But you did that. But the other thing is, like, you're basically waiting till everyone else have discovered that this business has value. That's really what you're waiting for, right? You found value. You have this proof of concept in your head for rational reasons, like you realize this business has value and other people haven't realized it. You put your money in there before this thing becomes hypey, right? And then when it becomes hyped up, that's when you sell. That's the fundamental mentality of everything I invest in. Does that make sense?
Yeah.
Yeah. And then if you look backwards, right? So in terms of how much money you might want to look into, that's just the fundamentals of bankroll management, and how it depends on how risk averse you are, right? So I'm sure you understand the basic concept here, but let me just reiterate for everybody. Fundamentally speaking, right? If you want to make a crap ton of money in a very short amount of time, then realistically speaking, you have to understand that you're going to be taking on a lot of risk. Because if there's not a lot of risk, then everyone will be rich, just by the nature of things, right? Whereas a healthy mentality to look at it is that if I want to make a lot of money in a short amount of time, then whatever amount of money I'm putting in, I should say I'm willing to, let's say, lose half of it. I might be able to make twice as much, but I should be able to be okay with the fact that I lost half of it by trying to make twice as much or 3 times as much, right? And you can just kind of build a scale to yourself, right? If I want to be even more aggressive, if I want to make a shit ton of money, then I need to invest more aggressively, and therefore I should expect the possibility of losing a lot of money very, very quickly, right? So if that's your mentality, then based on the fact like you had to figure out like what is reasonable, how much money are you willing to lose, right? So we're just gonna round numbers up. Let's say you have $10,000 to invest. Are you okay with losing all of it? That's your entire bankroll. If not, then you should probably invest half of it. Are you okay with that? If not, then you should probably like investing $1,000, right? But let's say you're super aggressive investment opportunities. Like if I want to invest in a stock, I think it might double. The opportunity is there, but also you are understanding the fact that it's super risky. So there's a chance whatever money you put in that one, you might lose half of it or even more or all of it. And so that's part of your investment. And then you look at something else that you might, in a year make 30%. That's also still aggressive, but I'm just kind of go with me right here. So like you make substantially less, a third less than what you would with a super highly aggressive investment. So based on that, you have an opportunity to lose a lot less money based on this approach. And so you put a little bit more money, right? So 3, 4, 5, 6 stocks you pick based on the amount of risk, the amount of gain that you expect out of it. You build based on that idea how much money you want to invest in each of them, and that's how you manage your money. And then at the end of the day, you kind of figure out, okay, so out of all the stocks that I want to invest in, this is the amount of money that I have available, and then you just distribute that relatively speaking to each other. Does that make sense?
Yeah. So I think so far, so what I've gathered is that essentially the mindset you need to go into it looking at is that, how do I begin to identify those opportunities that maybe haven't caught enough traction, or maybe not very many people have really caught on to them yet, that I believe will eventually catch on and will increase in price. And then in terms of, amount and what mix I do, of course, I know it varies from person to person, but my understanding now is essentially I should look at it from the perspective of, I should be comfortable with potentially losing, if not half, potentially the entirety of what I'm putting in,
yes,
under the premise that I have an opportunity to, 2x or whatever it is that I'm aiming for. Now, going in with that mindset, how do I actually identify those stocks? Some more context from my end, like I remember in college, and I forgot everything at this point, but from a finance class that was actually super interesting. But the teacher taught us, look at these. I think one of the documents was a 10K. Look at the debt to income ratio, like all these numbers that, frankly, at this point I don't remember at all. But I do remember it being very helpful and actually getting to the point that I was like, wow, like I feel like I could actually go look at these documents now and make an educated decision about whether or not I should buy this stock. And actually, for an example, the stock at the time that I was doing my homework on or my research on was Ashland Oil. And I remember being super excited. Like I understood what their 10K was. I looked at all those numbers, And I didn't have any money at the time because I was in college. But ultimately, like, I played out, and today I still watch it, and at least according to the stock price, it's done great. But that was my really long-winded way of asking that. Now that I have this mindset and that you've helped me build, what are the things I should actually be looking for to be able to identify those stocks?
Yeah, so that's a really, really great question. I break it down into two buckets, and I think it's really beneficial that you and I are both product managers. We kind of look at things in the right perspective in the first place. That's the second part of the puzzle. The first part is what you just talked about, which is there should be a benchmark that you set all investments to. And the benchmark is the raw numbers. You basically look at the raw numbers and you see, based on like the incoming revenue, net income, as a baseline, you should have like a fundamental set of baseline benchmark metrics that you should use for all stocks that you look at. And so usually what this means is that you look at specific numbers in the financial statements, like you pointed out. And what you want to do, really, like what I do, because I'm not doing this as a full-time job, right? So I'm trying to like streamline this as much as possible. But ultimately what I do is I look at revenue, I look at profit, and I look at it over like a really long ass time. If it's a long-term investment, then I would care about that a lot more. If it's a short-term investment, a lot of the times I care about the last 2-3 quarters to see how well they've been hitting those numbers. And also, if it's a short-term investment, what I also do is look at the macroeconomics of the situation. Whether there is a technological boom within the context of what I'm talking about, if this company fits in that space, then what I really care about is whether there's explosive opportunity in the next 2-3 quarters. If I'm holding it for 4 or 5 years, like kind of what you just said, then I really do care about how predictable it is over, let's say, a 3-4 year period. Because if it's like really, really unpredictable, then you're going to have to watch that stock pretty carefully all the time. Whereas if you're doing a short-term 2-3 quarter investment, how leadership performs, in my opinion, matters a lot less.
So you mentioned metrics though, but like I know you mentioned like looking at performance, but like what is the actual metrics that I'm looking at there?
Personally, I care very little about debt. I really do. When you're looking at a growing business, most companies in a growing state is going to lose a shit ton of money, or is carrying a lot of debt to create explosive growth. That's what startups do, right? They fundraise a shit ton of money, and then they use that money, like just grow like crazy as fast as possible, and then worry about making profit later. And so, if I'm doing a short-term investment, which is essentially anything less than 6 months, that's kind of how I'm looking at it. As a long-term strategy, if I'm investing in something that I plan on holding for 2-3 years, Microsoft, for example, in that case, yes, I'm making sure that they're not losing money quarter over quarter, year over year. I have to make sure that they're actually making money, like in the green all the time. Because if they're not, those kind of companies, blue chip companies, have a lot of institutional investors who's going to freak out. Kind of like TripAdvisor stock, for example. Institutional investors are going to freak out and start selling or force things to happen, because that's a different demographic of investors. They have a different expectation, and as soon as the company doesn't meet that expectation, bad things are going to happen, right? And then a very easy way that I look at things is look at how often, if you look at Yahoo Finance, for example, they have this pretty clear. You look at the surprise factor. There's a literal indicator called like percentage of surprise. So every quarter, every year, a company puts out this like growth expectations, right? If they beat that, then there's a surprise factor built in, and you basically expect that the bigger the surprise, the bigger the jump in stock price, because the price wasn't like the value wasn't built into the price, right? So that's what that surprise indicator indicates. So I do a very close monitoring of that, see how often that happens, and also inversely, if the surprise is super high, then maybe next quarter is just unreasonable, right? That's also another way to think about this stock is now overvalued. So those are some and at least in terms of numbers I look at, basically revenue, profit. Rarely do I look at debt, surprise factor 100%. And then the other thing I look at is when the quarter earnings come out, the other thing that the management does is they set a new expectation. So I will watch that very closely as well, just in terms of whether they're increasing their estimates, which usually is a hugely positive sign, or they're saying that they're meeting expectations, but there's an underlying tone that the industry might change, right? Those are some things I look at as a baseline. And then, first of all, does that answer your question?
Yeah. Now, I guess one question I have about that though is when you say that they put out their statement, their quarterly statements, and they say, yeah, we've hit our estimates or we've gone beyond. Is that specifically about sales? Is it about profit? What exactly are they trying to hit there?
That's actually a really good question. I'm going to answer that question in a different way. So what I do to streamline, again, coming back to streamline, right? Because ultimately I look at a ton of companies and I try to figure out what is worth my time in a very short amount of time. And the only really good way to do this, in my opinion, is that you find legitimate sources that cover finance. I get 4, 5, 6 different sources that I look at for every earnings about each of the company that I'm interested in to make sure that the values that I'm looking at make sense, right? So all of the numbers that they're highlighting are essentially all of the important things that they talked about in the earnings call. So instead of sitting through like a 2-3 hour earnings call, that's what I do. I spend like maybe 30-40 minutes and you compare all of these results, figure out which one is worthwhile to you in terms of what you look at. Does that make sense?
Yeah.
Yeah. And then circling back.
That makes sense.
Great. So the second part I wanted to talk about is like once I have this baseline expectation set for what I want to invest in. And by the way, this baseline is going to differ, right, between like a super risky but like big payoff kind of investment versus something that's long term, right? So once I have that expectation set, what I look at is the business strategy of the company, which again, that's where we come in terms of having a product management mindset. You essentially look at what they're currently doing, whether they're actually good at it, how much of the market they own right now, what user segment they're tackling, whether they have essentially a legal monopoly or not. And then you look at who are the incumbents coming in and also what their like next, let's say year-long or 2-year-long roadmap looks like. So one example is Microsoft and Google. They basically have somewhat of a monopoly within their space. Google has a monopoly in search. They basically own search. So everything involves around building this ecosystem around search, right? So if I'm looking at Google as an investment opportunity, I have an understanding that they basically own the entire market. If I don't care about them just upping their price to make more money, then I'll have to care about what new technology are they innovating to increase the size of their ecosystem to capture more clicks or capture more ad revenue, right? So that's kind of how I would look at that. Same thing like Microsoft, right? They have a monopoly in business suite stuff, right? Remote office productivity, well, office productivity in general, I guess. And so if they decide to swing their weight in a certain direction, do I as a product manager think that it makes sense? So for example, let's say they decide to go full on against Zoom, right? Because Zoom just made a shit ton of money. There's everybody who's in the video conference space, they're going to try to get more of that money as well. And so you think they'll try to do that. But to you, knowing something about Microsoft as is, do you think they're going to be successful? If the rest of the market think that they're not going to be successful, but for some reason you have a rational reason to think that they will be. For example, Microsoft is really good at bundling products. And you think that they're going to capture more market than what most people think they will do, then the stock can potentially be undervalued, and that's your investment opportunity right there. Does that make sense?
Yeah. So it's a very interesting, I don't think I've actually ever looked at, and this is, due to my lack of experience and also just naiveness, but I don't think I've ever actually looked at a stock and a business in that light. Like, of course, as a product manager, I look at what is the competition doing and so on.
Yeah.
But I've never really looked at it so much so as like, in the manner you just described, which is, look at their roadmap, look at what they're doing, like their actual actions, to be able to put a value on that. And at the same time, though, like, would you say though that there could be, I mean, of course, each person thinks differently and has their own logic, but like, could there almost be too much risk associated with making decisions based on that? If I say, if I just look at some company's roadmap and say, well, I think that's a really cool technology. I guess this is kind of what I did with Square, but that's a really cool technology. Sure, why not? Nobody's buying into it today. But I guess how do I actually know that that's a good decision-making process, though?
Yeah, that's a really, really good question. Of course, nothing is 100%, right? I mean, that's a given. The way I do this, especially coming back to the fact that like we're not full-time investors, we're not spending like fund managers. They spend weeks if not months on a single stock to try to figure out if it's worth investing. The way I'm doing it, I'm trying to fast track everything, right? And it seems to have worked out so far for the last 10 years. So that's the disclaimer here. How I do this is I invest in stuff that I actually use. So you imagine, bless you. So you imagine like let's say Airbnb. I just put out a video on Airbnb on this too. Airbnb right now is like overvalued like crazy. But at the same time, from my perspective, it's something that I can't see society going without, right? Because of my past experience with it, because of the fact that I think they address the user segment of rich people and people who just want a unique experience and bum it. There's a spectrum of their offerings, and they're adding experiences on top of it. And there is so much more of the market that they can tackle. So I think that their growth strategy makes sense. Their user segment is huge. They're tackling the hotel industry. They're pissing them off. So then they're getting the cities to fight back. All of these things, in my opinion, are good signs. And then you pair that with the fact that, do their benchmark metrics make sense to you as well? In terms of how much money they're currently making, how much money they're losing. Like, the cost of acquisition is a super important statistic in this circumstance. So you can figure out, like, in terms of growing, are they spending linearly, or the more they grow, the less money they need to spend and the more market they capture? Are they owning a monopoly, right? And then circling back to what I said about the fact that like you should invest in stuff that you use. If I stop using Airbnb, I'm gonna get more and more concerned about me investing in Airbnb, because anything that happens, anything that changes their product, I wouldn't know unless I use it, right? I would just read about it, and then at that point, I'm investing in several things like most people are. Like anything that I don't have a ear to the ground, like I'm gonna get super skittish about, and then I'm gonna find out what happened to it in the news, which is the worst thing you can do, because by then it's like investing after you read it in the news too, right? The value has already been built in, or the value has already been lost by the time you read it in the news, and now you're just like shit out of luck at that point. So based on your benchmark, based on your product analysis, you start investing, but the fact that you constantly use it gives you a better understanding of what you're investing and whether you should sell, that kind of stuff. And pairing those three concepts together is what's been working out really well for me. Thank you.